Benjamin Graham, often hailed as the father of value investing, penned the seminal work, The Intelligent Investor, in 1949. This book has since become a Bible for investors around the world, guiding them through the intricacies of the financial markets. This book, a cornerstone of financial literature, emerged in a post-war era marked by both economic optimism and uncertainty. The world was rebuilding, and people were looking for ways to secure their financial futures. Graham's teachings, however, transcended the turbulent times, offering timeless wisdom for navigating the complexities of the stock market. His insights were not just for the moment, but for generations to come. His principles, centered around rigorous analysis, long-term vision, and emotional discipline, remain as relevant today as they were decades ago. These principles have been the foundation for countless successful investment strategies. The Intelligent Investor is not a get-rich-quick scheme. Instead, it advocates for a methodical and patient approach to investing. It's a philosophical guide for building wealth gradually and steadily. Graham's approach teaches investors to focus on the long-term health of their investments rather than short-term gains. Graham emphasizes understanding the businesses you own, not just tracking stock prices. This deep understanding allows investors to make informed decisions and avoid speculative pitfalls. This long-term approach, grounded in fundamental analysis, forms the bedrock of value investing. It encourages investors to look beyond market noise and focus on intrinsic value. In an era dominated by short-term speculation and algorithmic trading, Graham's emphasis on patience and intrinsic value is a refreshing antidote. His teachings remind us that true wealth is built over time, with careful consideration and steadfast discipline. Graham draws a clear distinction between investing and speculating, emphasizing the importance of understanding the difference. Investing, for Graham, involves thorough research, a focus on intrinsic value, and a long-term perspective. It's about making informed decisions based on solid data and analysis. Speculation, on the other hand, often relies on market timing, short-term price fluctuations, and an emphasis on quick profits. This approach can be highly unpredictable and risky. He argues that while speculation might yield occasional gains, it's a dangerous game for most investors. The potential for significant losses is high, especially for those without deep market knowledge. Investing, according to Graham, is like buying a business, not just a ticker symbol. It's about owning a piece of a company and believing in its long-term success. It requires understanding the company's financials, its competitive landscape, and its future prospects. This deep dive into the company's fundamentals is crucial for making sound investment decisions. This approach, while demanding more effort, offers a path to sustainable wealth creation. It's a disciplined strategy that prioritizes steady growth over time. Speculation, in contrast, is akin to gambling, relying on luck and often leading to significant losses, especially for inexperienced investors. The allure of quick profits can be tempting, but the risks are substantial. One of Graham's most enduring concepts is the margin of safety. This idea has stood the test of time and remains a cornerstone in the world of investing. This principle emphasizes buying assets at a significant discount to their intrinsic value. By doing so, investors can protect themselves from potential losses. This discount acts as a buffer, protecting investors from potential errors in their analysis or unforeseen market downturns. It's like having a safety net in place. The larger the margin of safety, the lower the risk. This concept is crucial for long-term financial stability and success. Think of it like buying a car. You wouldn't want to overpay for something that might depreciate in value. You wouldn't pay the sticker price without negotiating, right? You aim to get the best deal possible. Similarly, Graham advocates for purchasing stocks below their true worth. This approach minimizes risk and maximizes potential returns. This margin of safety provides a cushion against market volatility and potential miscalculations. It's a strategy that helps investors sleep better at night. It's about buying $1 for 50 cents, ensuring a margin of error in your investment decisions. This way, even if things don't go as planned, you have a buffer to fall back on. Graham introduces the allegorical figure of Mr. Market to illustrate the stock market's often irrational behavior. Mr. Market is your business partner, offering to buy or sell shares of your businesses every day. However, Mr. Market is prone to mood swings, sometimes overly optimistic, other times irrationally pessimistic. The intelligent investor, Graham argues, shouldn't be swayed by Mr. Market's emotional roller coaster. Instead, they should capitalize on his irrationality. When Mr. Market is euphoric, offering inflated prices, the intelligent investor sells. When he's depressed, offering bargain basement prices, the intelligent investor buys. Warren Buffett, arguably the world's most famous investor, credits Benjamin Graham as his mentor and the intelligent investor as his investment Bible. Buffett's investment philosophy, centered around value investing principles, is a testament to the enduring power of Graham's teachings. He's a living example of their effectiveness. Buffett's success, built on identifying undervalued companies with strong fundamentals, underscores the importance of patience, discipline, and a long-term perspective. He's known for his extensive research, his focus on intrinsic value over market noise, and his willingness to hold investments for decades. His journey from a young investor to a financial titan showcases the transformative potential of Graham's principles. Value investing, while rooted in Graham's principles, has evolved over the decades. It's not just about finding undervalued companies in traditional industries. Today, value investors apply these principles to a wide range of assets, including technology companies, emerging markets, and even cryptocurrencies. The core tenets of value investing, rigorous analysis, a margin of safety, and a long-term perspective, remain as relevant as ever. Whether it's identifying undervalued tech giants or uncovering hidden gems in emerging markets, the principles of value investing provide a framework for navigating the complexities of modern markets. It's about finding value wherever it exists. The intelligent investor provides a comprehensive playbook for navigating the stock market. Graham emphasizes the importance of thorough research, understanding financial statements, and focusing on long-term value creation. He stresses the need for emotional discipline, urging investors to avoid impulsive decisions driven by fear or greed. The book advocates for a diversified portfolio, spreading risk across different asset classes. Graham encourages investors to view stock ownership as owning a piece of a business, not just a ticker symbol. This mindset shift from short-term speculation to long-term ownership is central to Graham's philosophy. Beyond the numbers, patience, discipline, and temperament. While the intelligent investor delves into financial analysis, Graham emphasizes that successful investing goes beyond crunching numbers. He stresses the importance of temperament, arguing that emotional discipline is crucial for navigating market volatility. Patience, he argues, is a virtue in investing. Graham reminds us that the market is not always rational in the short term. Successful investors, he argues, are those who can control their emotions, avoid impulsive decisions, and stay focused on their long-term goals. It's about having the discipline to stick to your investment strategy, even when the market tests your patience. Section 9. Value investing in the age of cryptocurrency and high-frequency trading. The investment landscape has changed dramatically since Graham's time, with the rise of cryptocurrencies, high-frequency trading, and algorithmic investing. However, the core principles of value investing remain surprisingly relevant in this new era. While the tools and technologies have evolved, the fundamental principles of value investing still hold true. The key is to adapt these principles to the modern context. For example, evaluating cryptocurrencies through a value investing lens might involve assessing their underlying technology, their potential use cases, and their long-term viability. The principles remain the same, even if the playing field has changed. The future of value, timeless wisdom for a changing market. As we look ahead, the principles espoused in The Intelligent Investor are likely to remain as relevant as ever. In a world of increasing financial complexity and market volatility, Graham's emphasis on fundamental analysis, risk management, and emotional discipline provides a beacon of clarity. The tools and technologies used by investors may continue to evolve, but the fundamental principles of sound investing, as outlined by Graham, are likely to remain timeless. The intelligent investor of the future will be one who can adapt these principles to new contexts, navigate emerging technologies, and maintain a long-term perspective. Section 11. Conclusion. Embracing the intelligent investor mindset. The intelligent investor is more than just a financial guide. It's a roadmap for cultivating a sound investment philosophy. Graham's teachings encourage us to be patient, disciplined, and rational in our approach to investing. They remind us that successful investing is a marathon, not a sprint. By embracing the principles of value investing, we can navigate the complexities of the market with confidence, seeking long-term value creation and building a more secure financial future. The intelligent investor is not defined by their IQ, but by their temperament, their discipline, and their commitment to Graham's timeless principles.